Hello and welcome. The title of this video isn't meant to be dramatic. It's a reality of our financial system, but it's crucial to understand exactly what it means. The government isn't going to show up at your home and seize your retirement funds. Instead, it has created a complex web of regulations around your 401k and IRA accounts. If you don't navigate these rules carefully, you could find that 25% to almost 50% of a withdrawal is lost to taxes and penalties, money that should have been yours. Starting in 2026, some of these rules are changing in ways that are already catching many retirees by surprise. In this video, I'm going to walk you through exactly when you might lose that money, how much is at stake, and, most importantly, what steps you can take to safeguard the nest egg you've worked so hard to build over many decades. Before we dive in, I encourage you to subscribe to this channel right now and activate the notification bell. The rules for retirement accounts are always in flux, and financial institutions often bury these critical details in complex legal documents. Our goal here is to bring them into the light. With that said, let's get started. We'll begin with the single costliest mistake that retirees often make with their savings. This is something that can happen even to people who followed all the rules for their entire career, only to stumble on one final regulation. When you contribute money to a traditional 401k or a traditional IRA, you receive an immediate tax benefit. You don't have to pay income tax on that money in the year you earn it. However, that tax obligation doesn't just vanish, it's simply postponed. At a certain point, the IRS mandates that you begin withdrawing that money and finally pay those deferred taxes. This mandate is known as the Required Minimum Distribution, or RMD. Here's how the rules are set up for 2026. If you were born between 1951 and 1959, your RMDs must begin at age 73.
This means, in the year you turn 73, you have to start taking annual withdrawals from your traditional retirement accounts. If you were born in 1960 or later, that RMD age is pushed to 75. The specific amount you're required to withdraw each year is determined by a formula based on your total account balance and your life expectancy, according to official IRS tables. This isn't a simple, fixed percentage. It adjusts annually based on your new balance and your increasing age. So, what happens if you fail to take your RMD? The IRS imposes a steep excise tax penalty, which is 25% of the amount you were supposed to take out, but didn't. For example, if you missed a required distribution of $20,000, that's an immediate $5,000 penalty, and that's on top of the regular income tax you'll still owe when you eventually do withdraw the funds. There is a bit of good news. If you recognize the mistake and correct it by taking the withdrawal within a 2-year window, the penalty is reduced to 10%. Still, the most prudent strategy is to be aware of when your RMDs begin and to arrange for them ahead of time. Major brokerages like Fidelity and Vanguard can calculate your RMD and set up automatic distributions if you instruct them to. Now, let's talk about the trap within the trap, the one that many people fall into without realizing it. When you first reach your RMD age, the rules give you a choice. You can take your very first RMD during the calendar year you hit that age, or you have the option to delay it until April 1st of the following year. Delaying sounds tempting because it gives you extra time, but it has a hidden consequence. If you choose to postpone that first RMD until the following April, you are still required to take your second RMD by December 31st of that same year. This forces you to take 2 full RMDs in one single calendar year. That means 2 significant chunks of taxable income are reported in the same 12-month period. This can easily push you into a much higher tax bracket for the year. It could increase the percentage of your Social Security benefits that are subject to taxation, and it might even trigger the costly Medicare IRMAA surcharges, which we will discuss in more detail shortly. For the vast majority of retirees, taking that first RMD in the year it's due, rather than delaying it to the following April, is the simpler and often far less expensive option. The second major change taking effect in 2026 involves a significant shift in how catch-up contributions are handled for higher-earning individuals. This rule change has caught many people off guard, because it was part of the Secure 2.0 Act passed back in 2022, but its implementation was delayed until now. Catch-up contributions are the additional funds that workers aged 50 and older are permitted to save in their 401ks, over and above the standard annual contribution limit. For 2026, the standard 401k limit is projected to be around $24,500. Workers 50 and over can contribute an extra $8,000, bringing their potential total to $32,500. But here's the new rule that's now in effect. If you earned more than $145,000 from your employer in the previous year, 2025, then all of your catch-up contributions for 2026 must be deposited into a Roth 401k account,
not a traditional pre-tax one. You lose the ability to make those extra contributions on a pre-tax basis. What does this mean for you in practical terms? If you are a higher earner who wants to make catch-up contributions, you will now be paying income tax on that money in the current year, rather than deferring it. This will result in a smaller take-home paycheck and a higher tax bill for the current year. Some people might view this as a drawback. However, others see it as a valuable opportunity, since money in a Roth account grows completely tax-free, and all qualified withdrawals in retirement are also tax-free.
The most important thing is to be aware of this change in advance, so you aren't blindsided when your paycheck looks different. There's also a special, more powerful catch-up provision that is specifically for people between the ages of 60 and 63. For this very narrow age group, the catch-up contribution limit is even more generous, $11,250 instead of the standard $8,000. When you combine this with the standard limit, someone aged 60 to 63 can potentially contribute up to $35,750 into their 401k in 2026. This is a huge opportunity to boost tax-advantaged savings, compressed into a short 4-year window. If you fall within this 60 to 63 age bracket right now, this is arguably the most powerful savings tool at your disposal. Once you turn 64, the limit reverts back to the standard catch-up amount. Next, let's discuss what I call the double hit. This issue can affect anyone taking RMDs, selling property, or experiencing any large income event during their retirement years. Most retirees have no clue this is coming until they get a notice that their Social Security check is smaller because of a higher Medicare deduction. Medicare Part B premiums are not a uniform cost for all retirees. If your modified adjusted gross income surpasses certain thresholds, $103,000 for a single person or $206,000 for a married couple, Medicare imposes extra charges. These are called the Income-Related Monthly Adjustment Amount, or IRMAA surcharges. These surcharges are applied on top of the standard monthly premium and can range from an extra $69.90 to a staggering $443.30 per person per month. Here is the mechanism that creates that double hit. Medicare determines your current premiums by looking at your tax return from 2 years ago. So a large RMD you are forced to take this year, in 2026, will increase your 2026 income. That income will then be used to calculate your Medicare premiums for 2028. This means that every time you make a substantial withdrawal from a traditional retirement account, whether it's an RMD, a Roth conversion, or just a voluntary withdrawal for a large purchase, you must consider the tax implications not just for this year, but for 2 years down the road. A $50,000 RMD might feel manageable from an income tax perspective today, but it could also lead to an extra $1,000 or more in Medicare costs 2 years from now. Retirees who are aware of this plan their large distributions with great care. They might spread them out over several years, time them to stay just under the IRMAA income thresholds, or use other strategies to lower their taxable income. One of the most effective and underutilized strategies is the Qualified Charitable Distribution, or QCD. If you are age 70 and a half or older and you have a traditional IRA, you are allowed to donate up to $108,000 directly from your IRA to a qualified charity. This direct transfer counts towards satisfying your RMD for the year, and critically, the amount transferred is completely excluded from your taxable income. You never pay income tax on that money. For 2026, the QCD limit is $108,000 per person. For a married couple where both spouses have their own IRAs, that's a potential $216,000 that can be moved to charities tax-free, all while fulfilling their RMD obligations. If you regularly donate to a church, your alma mater, a hospital, or any other nonprofit, this strategy allows your charitable giving and your RMDs to work in harmony rather than in conflict. Finally, let's address inherited IRAs. This is the area that most often catches families by surprise and where the financial losses can be the most significant. If you inherit a traditional IRA from anyone other than your spouse after December 31, 2019, you become subject to the 10-year rule. This rule mandates that you must completely liquidate the entire account within 10 years of the original owner's death. You have flexibility in how you take the money out during that 10-year period. You could take a small amount each year, or you could wait and take it all in the final year. But by December 31st of the 10th year following the death, that account balance must be zero. And remember, every single dollar you withdraw is counted as taxable income in the year you receive it.
The danger here is that many beneficiaries inherit an IRA and, not knowing the rule, do nothing for several years. They might then get a notice in year 8 or 9 that they have to withdraw the entire remaining balance in a very short amount of time. If the account has grown significantly and the beneficiary is now in their own peak earning years, the resulting tax bill can be devastating. A $300,000 inherited IRA that must be liquidated over just 2 years could easily push someone into the highest federal tax brackets, like 32% or 37%. The most tax-efficient strategy is to plan for this and spread the distributions out evenly over the full 10-year window, perhaps withdrawing about 10% of the account each year. This makes the annual income increase much more manageable. If you have a large IRA yourself and are thinking about how it will pass to your children or other heirs, it is essential to discuss these inherited IRA rules with a tax advisor now. There are advanced strategies, such as performing Roth conversions during your lifetime, naming a trust as a beneficiary under very specific conditions, or using charitable remainder trusts that can dramatically reduce the future tax burden on your loved ones. So let's quickly review the full picture. First, missing an RMD will cost you a 25% penalty on the amount you failed to take, though this can be reduced to 10% if you correct the error within 2 years. Second, be wary of the 2 RMD year trap created by delaying your first distribution to April 1st. It's almost always better to take it in the year you turn your RMD age.
Third, as of 2026, if you earn over $145,000, your 401k catch-up contributions must go into a Roth account, so plan for that after-tax impact on your paycheck. Fourth, the super catch-up window for those aged 60 to 63, allowing up to $35,750 in contributions, is a temporary and powerful opportunity. Fifth, remember that large withdrawals can trigger higher Medicare IRMAA surcharges 2 years later. Always plan with this 2-year lag in mind. Sixth, a qualified charitable distribution of up to $108,000 can satisfy your RMD with 0 income tax if you are 70 and a half or older. And seventh, inherited IRAs are subject to a 10-year distribution rule. Spreading out those withdrawals is key to avoiding a massive tax hit. The government has spent decades creating these rules. They are complex and they aren't going away. But by knowing what they are in advance, you can make informed decisions that allow you to keep more of the money you worked a lifetime to save. That knowledge is the difference maker. Please subscribe to the channel and share this video with a friend or family member who has a 401k or an IRA. I'll see you in the next one.